Folks, today I want to talk about sector rotation that I'm seeing take place and two hot stocks that are a big part of this sector rotation. So let's get into it. This is really timely. Let's pay attention. Now I'm sharing my screen right now and you could see all the 10 major sectors of the S&P 500. If you take all these 10 sectors, they have between 40 and 60 stocks in each. Add them together, you'll get the S&P 500. And as you can see here, the energy, financial, industrial are leading. Technology, utilities, consumer staples are lagging. Now here's what's really interesting about this. Consumer discretionary and technology, they're usually next to each other, just like utilities and consumer staples are usually next to each other, and industrial and basic materials. They're like the opposite end of the same coin, okay, or opposite side of the same coin. But consumer discretionary, whenever consumer discretionary falls out of line with technology, that means the market becomes fragmented. And that means something is going on. Like right now, the NASDAQ is trading, NASDAQ 100 FANG stocks are trading below the 50-day moving average, and is telling us that things are not running as they should. Now, what you want to do during these times is you don't want to be loaded in the entire index. You don't want to be loaded in the S&P 500. You want to pick which sectors you want to be long and which ones you want to be short. So for example, right now, if you're holding the S&P 500, if you think that the best way is just, hey, I'll always have the best stocks and the best sector just by being in the entire S&P 500, that's not the case. For example, over the last 6 months, you would have only made in consumer staples 1.31%, but in energy, you would have made 38%. So imagine over the last 3 months, you just had energy, financial, industrial, and basic materials. Your portfolio would be up about 28, 30%, whereas if you had the entire S&P 500, you would have some of these stocks that gave you 10%, 6%, 7%. And look, in the last 30 days, we've had technology down 3.72%. That's all part of that same S&P 500. So by taking specific sectors that are moving higher and focusing on them and ignoring sectors that are lagging, you can put yourself in a winning position. And I've got a better one for you. What if you can buy calls, you can go long on the bullish sector, and you can go short on the weakest sectors? That's a double whammy. You can make money from the market going up and down at the same time. This is very exciting. So basically what I'm seeing, the bottom line is you don't want to be in health, technology, utilities, and consumer staples and real estate, but you do want to be in energy, financial, industrial, and basic material. Now, there's two stocks that are not really in the tech sector. They are here, they are alive because of the tech sector, but they're not part of that FANG tech. They're more of companies that use technology to achieve the goal of transportation. And transportation is hot right now. Transportation is an industrial sector, and industrial is 3. And remember, interest rates are going higher. What sector benefits the most? Industrial. When interest rates go higher, they usually go higher because the economy is expanding. It's getting hot. And what usually causes, or what usually happens when the economy gets hot? Industry grows. The industry, industrial, it expands. So we're going to talk about two stocks that are on my radar right now that are getting a lot of buzz from investment banks. So the first one is Lyft. Let's talk about it. Now, Lyft. Lyft is a ride-sharing company. It operates transportation platform, transportation. It's not a huge stock, and it's up 205% this year, all right? Not this year, over the last 12 months. Now, the company or investment banks expect the ride-sharing volume to grow in excess of 100% in the week ahead, as the company recovery appears to be ahead of schedule. Now, let's look at a chart of the stock, and you'll see what I'm talking about. I really like how it's looking too. Now, Wedbush Securities, they think that the positive trends could extend for Lyft with springboard-like pent-up demand. Look at what happened with Miami this spring break. People are going crazy, literally crazy. People want to get out. There's pent-up demand out there, and it's on the horizon, and much more profitable model on the other side of the vaccine. Now, the firm notes, Wedbush Securities notes, that Lyft doesn't have regulatory legal employee contractor headaches issues in Europe like Uber does. So Uber, the food delivery businesses, which can drag on margins. Keep an eye on Lyft during the next week for an update on ride-sharing trends throughout this, a lot of corporate blogs that we see on the internet and from us. But again, we're now going on the other side of the vaccine. I think we're going to see a lot of pent-up demand, people traveling, people using companies like Lyft. And what is Lyft doing technically? Look at this. It's at a 6-month high. Let's look at 9-month. 9-month high. 1 year, 1 year high. 2 year? Well, look at that. We are now at not a 2 year, but almost a 1.5 year high. I like this price action. Interest rates are not impacting, and I think we're going to see more upside from the company. I like this congestion. It usually leads, congestions are low volatility price actions, and they typically lead to more upside. Now, the second stock I want to talk about, this is XPeng. XPeng is, if you don't know what they do, they market and make smart cars in China. That's right, smart cars. Transportation. And I told you folks beginning of this year, anything global with transportation, I'm liking this year. Now, if you look at the stock, and the stock over the last 12 months is up 79%, all right? So XPeng is conducting this week the longest autonomous driving test in China of a mass-produced vehicle, all right? Now, the company says this expedition will showcase the company's or the capability of its navigation-guided pilot, and which XPeng's full-stack in-house developed autonomous driving solution for complex scenarios on their highway, all right? So they're going to be driving across 10 cities in China. The expedition is being joined by more than 200 auto journalists, electric vehicle enthusiasts, and industry experts over the course of 7 days, meaning XPeng could see some publicity by the end of the week if the autonomous driving goes smoothly. Keep your eye on the stock. Am I recommending it now? No, it's below the 50-day moving average. But I believe this is going to be a stock that bounces back. So if it breaks above 50, I'm going to be going long ping. I hope that helps. Keep your eye for the buzz on Lyft and XPeng over the next week. And keep in mind, we're seeing major sector rotation. Until we see technology and consumer discretionary together, we are going to be in a fragmented market. And remember, you don't have to put everything into the S&P or the NASDAQ. You can pick each sector rotation. You can go long certain sector, you can go short certain sector, you can avoid certain sector, you can buy puts, you can buy calls. You could do a lot better than the broad market with individual sectors. Hope that helps.